Welcome to Personal Finance Channel. In today's video, we will review some of the best recession-proof dividend stocks to buy in 2023. So, before we start, please like and subscribe to our channel for weekly updates. There is a lot of speculation that a recession may be coming in 2023. The Federal Reserve has kept boosting interest rates in an effort to curb inflation, which has already begun to slow down a number of economic sectors. More economically sensitive corporations may lower their dividends in the event of a full-blown downturn. However, many dividend stocks ought to be resilient enough to survive a downturn. Let's take a look at some of these stocks in this video. 5. Agree Realty. Agree Realty is a long-proven dividend stock that should resist a recession. This real estate investment company, REIT, situated in the suburbs of Detroit, owns more than 1,700 standalone retail properties and ground leases, which it rents to reputable tenants across the 48 contiguous states. That includes companies that have weathered previous recessions, like Home Depot, Dollar General, Walmart, and Kroger, to mention a few. Since going public in 1994, Agree Realty has experienced market volatility while also producing a total return of 620%, about 60% more than the S&P 500 and more than twice the benchmark Vanguard Real Estate ETF. The dividend distributions of this retail REIT have grown at a compound average annual rate of 5.8% over the last 10 years, making it a dependable source of dividend income. Agree pays monthly as well, and at its current share price of roughly $72, it is earning about 4%. 4. Camden Property Trust. Demand for apartments typically remains stable throughout recessions. They need a place to live, and economic downturns make people less likely to buy large items like houses. As a result, during a recession, multifamily REITs typically produce stable income, making them wise investments for people worried about a downturn in the upcoming year. The business's credit is A-rated and supported by extremely low leverage ratios. It also has a portfolio that is incredibly robust. The Sun Belt region of the country, where Camden has 171 communities spread across 15 markets, has some of the best employment and migration trends in the nation. These characteristics give Camden's dividend, which yields 3.4%, an extremely secure base. By increasing its funds from operations, FFO, at a faster rate than the payout during the past 10 years, the company has further solidified the basis supporting its dividend. 3. Alexandria Real Estate Equities. Investing in office space for the technology and life sciences sectors is the primary focus of Alexandria Real Estate Equities. Even if the trend toward working from home has made office REITs less popular, not all of them are the same. The clientele of an office REIT like SL Green Realty differs significantly from that of Alexandria. Eli Lilly, Moderna, and Bristol Myers Squibb are some of Alexandria's largest tenants. Universities and government agencies, as well as tech giants like Uber Technologies, are also significant tenants. Healthcare organizations often fare significantly better during recessions than cyclical or consumer discretionary businesses. 2. Brookfield Infrastructure. Brookfield Infrastructure operates a diversified portfolio of infrastructure businesses across the utilities, energy midstream, transportation, and data sectors. The business's revenue stream is fairly consistent. Approximately 90% comes through long-term agreements or pricing arrangements that are governed by the government. In the meantime, 75% are volume risk-free, and 70% are inflation-indexed. Due to the fact that it benefits from inflation and won't be much affected by a recession in the economy, it is perfectly suited to the current situation. 60% to 70% of Brookfield's reliable cash flow goes toward paying out its dividend, which yields 3.6%. This enables it to keep a sizable portion to pay for upkeep and projects for organic growth. The business has a solid investment-grade credit rating, a large amount of liquidity, and a majority of long-term fixed-rate debt. These elements provide its dividend a very solid base. 1. Kinder Morgan. Investors might benefit from the massive dividend that yields 6.3% offered by natural gas pipeline firm Kinder Morgan. That payout has a fairly solid base since long-term agreements, rate structures that are subject to government regulation, and hedging agreements secure about 94% of its earnings. However, the company only projects that it will be able to cover its dividend next year with 53% of its relatively dependable cash flow. Kinder Morgan already unveiled plans to increase its payout by 2% next year, which would mark its sixth straight year of growing the dividend.